In my recent video on bank trading strategies, I talked about 4 popular ways that bank traders trade, including something called mean reversion or arbitrage. I went over it briefly, and so many of you wanted me to give you a more detailed breakdown of the trading strategy. So that's what we're going to do and cover in this video today. Mean reversion or arbitrage are fancy words used by bank and hedge fund traders to basically justify their big degrees and their high-paying jobs, where in reality, it involves identifying things that are basically just out of whack, out of the norm, and they're trading or betting on it returning back to normal, going back to the mean, or returning to the average. That's what mean reversion refers to. Arbitrage, on the other hand, means identifying price differences that shouldn't be there in the first place, and then taking a trade based upon that idea that the anomaly will disappear. Now, I'm not wearing pajamas today, but as individual traders, we can also find ways to apply this philosophy in the comfort of our own home. And that's what I showed you in my last video. We don't need to have access to complex, high-frequency algorithms, but we can also assume that on a short-term basis, when prices get overextended, they'll end up returning back to the average, back to the norm, where normal things are occurring. There are many ways to identify overextension, but here's one way that I like to do it. And that's using something called Bollinger Bands, which basically measure how far away the price is away from the average. So let's go ahead and go to the charts so I can show you exactly how this works. Okay, so let's start with a blank chart, and I'll show you how to add on the Bollinger Bands. So on TradingView, you need to click on Indicators, and you just type in Bollinger Bands. So when you type in Bollinger Bands, you will get the standard Bollinger Bands. And I'm going to add on 2 bands and show you how we put on 2 sets of Bollinger Bands to create this trading strategy. So whenever you have Bollinger Bands on your charts, you always get the 20 SMA and the 2 standard deviation as the default. So what this means is that the blue line, the middle line, is the average, and the lines above and below represent 2 standard deviations away from the average. So the idea is that 98%, so 100 minus 2, 98% of all price action should be encompassed within these 2 bands. And that's, or basically 98% of the overall average. So what I like to do, first of all, is to make these all the same color. So I'm not looking at this rainbow panel. So we've got the 20 SMA. We've got the 2 standard deviations. So I'll leave the basis blue because I like that to be a little different. Then we're going to change the upper band to be black, and we're going to change the lower band to be black as well. And we don't need the background. So this is the default. Now we've added another set of Bollinger Bands, which we need in order to measure extreme conditions. And that's going to be the 3rd standard deviation Bollinger Band. So remember, the inputs and the defaults are 20 period 2 standard deviation. So I simply changed this to 20 period 3 standard deviation. And we don't need the basis because we're going to keep the original 2 standard deviation basis. And once again, I change all of these to black. And I change this to black, and I remove the background. So now you've got the indicators that I use to measure overbought, oversold conditions. And this is the way you add them to your charts. And we look at this. We look for extreme extensions on 15-minute charts. This is the strategy that I showed you that we can use to kind of mimic the techniques of bank traders. So what we want is we want to look for a couple of things. I'm going to show you the what I like to call the quote-unquote perfect trade so that you can understand how that works. And we're going to then dissect all of the trades that we see on the Eurodollar chart. So the perfect trade is something that looks like this over here, where we basically see the currency pair Eurodollar drop and touch, or ideally close below, the 3rd standard deviation Bollinger Band, which is the outside band. So the first thing you want to see is you want to see it close below the 3rd standard deviation Bollinger Band. And then what you want to see is you want to see it move back above the 2nd standard deviation Bollinger Band. So what this is telling us is that we had an extreme condition, and then it recovered and went back towards normal conditions. So we see a close above the 2nd standard deviation Bollinger Band. But what we want to make sure is that it truly has formed a bottom. So we want to make sure that it makes a little bit of a new high, either, by no fewer than 2 pips, somewhere between 2 to 5 pips. I leave that as your discretion. But we need to see a new high in excess of 2 pips in the euro dollar. And when we see that, that's when we want to go long in this case with a stop at the swing low here. So the stop at the most recent low, I'm going to remove that arrow, the stop at the swing low. And then what you want to do is you want to target either the midline, in this case we're too close to the midline, or the Bollinger Band on the other side, and then trail your stop accordingly. So I'm going to break down these rules again over here so that you can understand. Step number 1, let me get closer to my screen. You want to see, for a long trade, a close below the 3 standard deviation Bollinger Band. Then you want to see a close back above the 2 standard deviation Bollinger Band. So this was step 1 here. Then step 2 is this next arrow right over here. And then step 3 is we just don't buy blindly. We want to look for a new high, a high that's above this candle here. I like to call it a new high greater than 2 pips. Then you want a swing low stop, just to basically from the extreme candle. So this is the swing low. And then you want to target the BB band on the other side, BB band midline, or the second S standard deviation Bollinger Band on the other side. And you can even continue to trail your stop, and then ideally capturing more than 20 pips, and you can trail your stop based upon that. So these are the trading rules. And I'm gonna leave it up here for a second, and you can always go back in the video, and I'll put it in the description so that you can refer back to this. So this is our perfect setup. Now I'm going to review the short trade. I'm gonna remove all this stuff. The short trade, let's see if we see any short trades here. Now you can see it doesn't happen very, very often, but like this one looks like it happens, but it's not more than 2 pips. And Eurodollar has been in more of a trend. This is, it's not, this one already touched the middle line. We had a lot more long trades than short trades, but we'll review them all. Let me just find a perfect short trade to show you so that we can understand the rules. Here, we get a close at or above the 3rd standard deviation Bollinger Band. Then you wait for it to close below the 2nd standard deviation Bollinger Band, and you make sure it drops below it by the low by more than 2 pips. So this is 1.05. So the low must be 1.0498, which you pretty much get over here. So 1.0498. So you get your stop, you enter the trade here. Your stop is going to be at the swing high over here. And then you can see that it goes to the Bollinger Band.